We open today's coverage with a geopolitical shock that is already moving energy markets and forcing traders to reassess the risk premium embedded in crude oil prices. A UN-coordinated Hormuz Strait evacuation plan has been abruptly paused after a container ship was struck near Oman, with U.S. officials directly attributing the attack to Iran. This is not a minor diplomatic hiccup. It is a full breach of the peace deal framework that markets had accepted as a working baseline, and the implications for energy supply chains, defense spending, and equity risk premiums are significant and immediate. The Hormuz Strait is the single most consequential choke point in global energy infrastructure. The specific incident involved a container vessel struck near Oman, the first confirmed maritime attack under the reported Iran peace deal framework, a development U.S. officials have attributed directly to Tehran. The UN subsequently paused its coordinated Hormuz evacuation plan, signaling that the diplomatic architecture surrounding safe passage through the strait has fractured. The strategic importance here cannot be overstated. Roughly 21% of all seaborne crude oil transits the Hormuz Strait, meaning any sustained disruption does not stay regional. It transmits immediately into global crude benchmarks, freight insurance markets, and the risk assumptions underpinning energy equities worldwide. Brent crude conjoint equals F is already trading at 74.41, up 1.72% on the session. What makes this event particularly destabilizing is not just the physical attack, but what it does to market psychology. Traders and risk desks had priced in a working peace framework, meaning no attacks were expected under the agreement, and the geopolitical risk premium in crude had been compressed accordingly. That baseline assumption is now invalidated. The macro transmission mechanism is straightforward. If Iran-linked actors are willing to strike vessels even while a peace deal nominally exists, then the entire category of geopolitical de-escalation trades built around that deal must be unwound. Safe haven flows into gold GC equals F are a direct expression of that repricing. The fragility of the diplomatic architecture is the real story here. The primary market impact lands squarely in energy and defense. WNT offshore crude Colgate-Palmolive equals F is trading at 71.08, while Brent conjoint equals F at 74.41 is already printing its strongest session gain at 1.72%. The divergence signals physical supply disruption fears rather than financial positioning alone. Gold GC equals F is absorbing safe haven demand alongside silver shoulder innovations equals F. On the defense side, Lockheed Martin and RTX carry a conflict premium when Hormuz tensions escalate, though traders should wait for clarity on escalation trajectory before sizing into those names. Critically, the 10-year Treasury yield at 4.40%, up 55 basis points on the session, suggests the bond market is pricing stagflation risk, not a clean flight to quality rally. There are 5 levels every trader should have on their screen right now. First, WNT offshore Colgate-Palmolive equals F at 71.08 is the current support floor. A push towards 75 on sustained attacks changes the energy narrative entirely. Second, Brent conjoint equals F at 74.41 is a key pivot. A breach above 78 would signal that the market is assigning a durable geopolitical premium to crude. Third, the VIX at 17.64 is still relatively benign. A move above 20 would be the clearest signal that equity risk-off is accelerating beyond energy markets. Fourth, gold GC equals F sustained above 4,100 would confirm elevated uncertainty is broadening. Fifth, watch whether Iran formally withdraws from or reaffirms the peace framework. That diplomatic signal will determine whether this is an isolated incident or the beginning of a sustained escalation cycle. The bottom line is this. The peace deal narrative that had compressed Hormuz risk premiums is no longer operative, and portfolios built on that assumption need to be stress-tested today. The rise in Treasury yields intraday is not a normal flight to quality signal. It reflects stagflation pricing, meaning investors are simultaneously worried about inflation from higher oil and growth damage from geopolitical disruption. Hedging equity longs with exposure to gold GC equals F, WNT offshore Colgate-Palmolive equals F, and long-duration bonds make structural sense in this environment, while Lockheed Martin and RTX deserve a closer look if escalation continues beyond this initial incident. Monitor Fed communication closely. Any shift in rate cut language given this oil shock will matter enormously for the S&P 500 and the Nasdaq 100. That's the full picture on the Hormuz situation as it stands. Coming up, a story that's moving global bond markets in a very different direction. Turning now from our first story, we close out the trading day with a question every portfolio manager is wrestling with heading into the second half of the year. Is this rally built on solid ground, or is it showing cracks beneath the surface? The S&P 500 sits at 7,414 and the Nasdaq 100 at 28,978, both posting barely positive moves of just 0.06% and 0.05% respectively as of this morning. Market commentator Mike Santoli has flagged what he calls erratic behavior under the hood, a first half that looked great on the headline numbers, but told a much more complicated story in the internals. Here is the factual anatomy of H1 2026 as markets wrap today. The first half was defined by a sequence of leadership handoffs. Semiconductors led early. Mag's 7 megacap tech carried the baton for weeks, and now the market is attempting to rotate into broader non-tech names as both of those groups show fatigue. The Russell 2000, tracked by the Russell 2000, is actually down 0.18% today to 298.43, underperforming even the flat large-cap indices. Meanwhile, the Nasdaq 100 and the S&P 500 are barely positive. This divergence, large-cap tech holding while small-cap slide, is precisely the kind of fragmented internal structure that Santoli argues raises legitimate doubts about the rally's true integrity heading into the second half. The deeper issue here is concentration risk, and it matters enormously for how the second half plays out. When a handful of megacap names, the Magnificent Seven, drive the bulk of index gains, the headline S&P 500 level can look deceptively healthy while the majority of stocks lag badly. Historically, rallies built on narrow leadership either broaden into genuine bull markets or collapse when that narrow leadership exhausts. Right now, we are at exactly that inflection point. The rotation attempt into cyclicals and financials is the market's way of searching for new earnings growth drivers now that the artificial intelligence-driven semiconductor narrative has run its initial momentum phase. Whether it finds them is the defining question of Q3. Every major asset class has a stake in how this rotation resolves. If the broadening succeeds, the financial sector financials and cyclicals benefit as capital diversifies away from concentration in a few megacap names, and the Russell 2000 at 298.43 becomes the trade to watch for upside confirmation. If rotation stalls, the Nasdaq 100 and the S&P 500 could spike higher on renewed megacap concentration, but the underlying market structure becomes dangerously brittle. Adding urgency, the bond market is flashing stress signals. The 10-year Treasury yield is at 4.40%, and the 5-year yield sits at 4.16%. The short-term funding markets have shown material movement intraday, suggesting tail risk hedging activity running simultaneously with the equity rotation debate. There are three specific tripwires traders should have on their screens heading into Q3. First, the Russell 2000 at 298.43. A break below 295 would signal small cap rollover and confirm that the rotation is failing, not broadening. Second, the VIX at 17.64 is sitting in a zone of relative complacency. A meaningful spike would indicate that conviction is cracking broadly and that risk-off positioning is accelerating. Third, the 10-year Treasury yield at 4.40% is key resistance for rate-sensitive sectors. If yields push materially higher from here, financials lose their rate spread tailwind and growth stocks face renewed multiple compression. Watch Brent crude at 71.08 as a secondary cyclical signal. Sustained energy strength would support the broadening rotation thesis. Here is the bottom line as we wrap both stories covered today. The S&P 500 at 7,414 and Nasdaq 100 at 28,978 look fine on the surface, but beneath those numbers, the market is sending mixed signals that matter enormously for second-half positioning. Rotation from Mag 7 into broader cyclicals and financials could represent healthy diversification and a genuine expansion of earnings leadership. Or it could be the early signature of exhaustion masking narrowing conviction. The answer will reveal itself at the tripwires. The Russell 2000 below 295, the VIX moving meaningfully higher, and the 10-year yield sustaining above 4.40%. Those are the two stories that matter most heading into Q3 2026. The full breakdown is up. If this kind of deep dive market analysis helps you trade and invest smarter, hit subscribe and turn on the notification bell so you never miss a daily recap. We break down the stories that move markets every single trading day. See you tomorrow.